Ever wondered how government decisions can make or break your wallet? Imagine a world where your money's value changes overnight, all because of choices made in distant offices. Well, that's the power of fiscal policy. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Fiscal policy is the government's toolkit for steering the economy, using spending and taxation to influence everything from job creation to inflation rates. Unlike monetary policy, which central banks control, fiscal policy is in the hands of elected officials, directly impacting demand, employment, and economic growth. But why should you care? Because these decisions ripple through your daily life, affecting your disposable income, job prospects, and even the cost of your morning coffee. When governments open their wallets, it's called expansionary spending. This could mean more money for roads, schools, or social programs. It's great for stimulating growth, but too much of it can lead to inflation. On the flip side, contractionary spending involves tightening the purse strings. This helps keep inflation in check and can make a country's finances look healthier to investors, potentially strengthening the currency. Taxes are the other side of the fiscal coin. Lower taxes might put more money in your pocket, encouraging you to spend or invest, but it also means less revenue for the government. Higher taxes can slow down spending but help reduce deficits. The balance between these approaches can make or break investor confidence in a currency. Now let's talk inflation, the silent thief of purchasing power. When governments spend more than the economy can handle, it's like too many people chasing too few goods. Prices go up, and suddenly your money doesn't stretch as far. This inflation can make a currency less attractive to investors, leading to depreciation in foreign exchange markets. It's a vicious cycle that can erode the value of your savings. Government borrowing is another piece of the puzzle. When governments need cash, they issue bonds. But this can push interest rates higher as they compete with private borrowers for capital. Higher interest rates might attract foreign investors, strengthening the currency. However, if borrowing looks unsustainable, it can scare investors away, leading to capital flight and a weaker currency. Countries with strong fiscal discipline often enjoy stronger currencies. Think of it like a credit score. The better you manage your finances, the more trust you earn. Nations with low deficits and stable debt to GDP ratios are seen as safer bets, making their currencies more attractive. But excessive deficits can undermine investor confidence faster than you can say economic crisis. Let's look at some real-world examples. The US dollar often remains strong, even with high deficits, because investors trust us institutions. In the Eurozone, fiscal rules like the Stability and Growth Pact aim to keep member countries in line. But emerging markets tell a different story. High deficits and inflation often lead to rapid currency depreciation. The U.S. stimulus spending during recent crises is a fascinating case study. These packages boosted growth but raised eyebrows about long-term deficits. Yet, the dollar stayed strong thanks to global trust in U.S. institutions. In Europe, fiscal rules help maintain euro stability, though crises like Greece's debt show what happens when discipline slips. History offers some stark lessons from high-deficit countries. Nations like Argentina and Zimbabwe saw their currencies collapse due to uncontrolled spending, extreme examples of fiscal policy gone wrong. These cautionary tales show just how crucial responsible fiscal management is for currency stability. So what does all this mean for you? Currency fluctuations can make imports more expensive or cheaper, affecting everything from gas prices to the cost of your favorite imported goods. A weaker currency might boost exports, helping some industries, but it can hurt your purchasing power for foreign products. As an individual, you should think about how these fiscal trends affect your savings and investments. Consider inflation risk, currency strength, and fiscal policies when planning your financial future. Investing in assets tied to stable currencies can help preserve your wealth in turbulent times. To wrap up, fiscal policy is a powerful force shaping the value of your money. Government decisions on taxation, spending, and borrowing directly influence inflation, interest rates, and investor confidence, all of which drive currency strength or weakness. These aren't just abstract concepts. They have real-world impacts on your wallet and financial future. So what's your next move? Stay informed and keep an eye on fiscal trends. Whether you're planning a big purchase, considering an investment, or just trying to make your paycheck go further, understanding how fiscal policy affects currency value can give you a crucial edge. Remember, in the world of finance, knowledge truly is power, and it might just be the key to growing and protecting your wealth in an ever-changing economic landscape.